Hi, my name is Warren Dueck, and I'm in Vancouver, and I'm joined by my colleague, Cooper Xu in Calgary. Good morning, Cooper.
Morning, Warren. Morning, everyone.
First thing, I just want to say our hearts go out to our colleagues in Andersen Global in the Ukraine. Obviously, there's some very serious events taking place there, and I know you share those thoughts too. Our focus in today's webinar is about U.S. citizens resident in Canada. We had someone comment saying, hey, we had some unusual acronyms and things like that, mysterious words. We're going to try and talk in real kind of basic language today. This is about helping you solve your problems, not talking in tax code language. So Cooper, we're going to go till about 10 o'clock. We're going to have our questions at the end of the session. So feel free to write those into us as we go along. The subject is going to focus mostly on U.S. citizens resident in Canada. The important thing to note here is that for most U.S. citizens resident in Canada, most or all their tax gets paid to Canada, but their complexity about their tax affairs is heavily weighted to the U.S. side. So we're going to talk some about Canadian tax issues, but they're going to predominantly be on the U.S. side and some of the unusual issues that Americans face when they live outside the United States. So as I mentioned, we're going to have questions at the end, so please go ahead and submit your questions. We're going to also ask you to do a survey. So we hope you give us comments. We appreciate your feedback, subjects, questions. We'll try and follow up with you. If you want a live transcript, if you look in your Zoom screen, you'll see a closed caption label or CC label on your screen, and you can actually get a readout. I think it's relatively good. So I tried it out yesterday with supercalifragilisticexpialidocious, and it seemed to work. So you feel free to use that if that's helpful for you. Our agenda today, again, focuses mostly on U.S. subjects. We'll throw some Canadian ones in there, but just some common issues which we find that are difficult for our clients to deal with and are commonly misunderstood by people, including sometimes other tax advisors too. We specialize in cross-border taxation. We work extensively in this area. About 90% of our work is on Canada-U.S. cross-border tax matters. So I'm going to pass off the first subject here on U.S. tax filing basics to Cooper Xu. So Cooper, I'll let you take it away here.
Thanks, Warren. Thanks, everyone. So we started from these slides, talk about the basics of the U.S. tax regime. So no surprise here, it's very similar to Canadian tax. In the first slide, you will see who are subject to U.S. tax, even though maybe you live in Canada. So for U.S. citizens, the U.S. tax based on the citizenship, on the worldwide income. So even though you live in Canada, that does not mean you cut a tie with the U.S. for your annual tax filing. It's different to Canada, when you leave Canada, even though you keep your Canadian citizenship, but you say, hey, I established a home in a foreign country for tax purposes, then you're deemed to have left Canada. You just filed last year return for Canadian tax filing. But the U.S. is different. You live in Canada forever. You need to file Canadian tax, but you still need to file U.S. tax for U.S. citizens. Also, for the resident alien, that's no difference. I mean, if people live in the U.S., even though they're not U.S. citizens, they have to file U.S. tax return. So based on some, like a green card, that's very important category. Same to U.S. citizens, no matter where you live, as long as you carry on your green card, even though it's already expired. The card is already expired. But for tax purpose, if you have not terminated your green card to notify the tax authority or immigration office, you're still subject to US tax, even though you live in Canada now.
So, Cooper, people with a green card need to actually formally abandon their green card. And typically that means going to a consulate or a port of entry into the US and surrendering it and receiving in return an immigration form I-407. So there is a process there, and people that have green cards that they have not formally abandoned are still subject to US tax regardless of where they live in the world.
Yeah, we saw lots of people got confusion in that regard. They thought, hey, I'm not American. I just got a work visa. I got green card, but I changed my mind. I moved back to Canada. All of my family is working out here in Canada. But sorry, for tax purposes, you would have to do procedurally something like file the form to notify them to have a clear cut with the U.S. tax. So that's basically, the non-resident alien usually is for for Canadians here, even though you're not subject to worldwide income to the U.S. However, if you have any U.S. sourced income, let's say you sell the U.S. real property, or you have some stock option incomes or pension incomes, that could be subject to some U.S. tax filings if withholding tax have not been done correctly.
Yeah, so U.S. citizens and resident aliens of the U.S., even if green card holders living in Canada would count, they're subject to U.S. tax on their worldwide income. But non-resident aliens of the U.S. are only subject to U.S. tax on their U.S. source income.
That's right. So that's just basic explain, who are subject to U.S. tax. Of course, there's lots of details to determine whether you are a resident or a non-resident. Lots of exceptions, exemptions, and also by the treaty, there's some different claims. You can treat taxpayer as a different taxpayer, for the residency purposes. So once we figured out those, the next step, you especially for U.S. citizens who live in Canada, you would need to figure out which filing status is best to you. This is new to Canadian, because in Canada we file Canadian tax return individually. Even though you share some credit with the spouse, but basically you report your own income. In the U.S., there's options, you can file as a family basis. You can say married filing jointly, or you can file separately, or there's some other like a head of a household, there's a single. So Warren will talk about the details in the next slides. So I will just skip this. So next one is income inclusion. In Canada, you report all of your income based on the Canadian tax law. However, if you are U.S. citizens live in Canada, when you file your U.S. tax return, for the most of the part, the income inclusion rule, those rules are similar. However, there is some difference. So you need to be careful. Some income could be, exempt or deferred for Canadian tax purposes. However, for U.S. tax purpose, maybe you have to include your income in this year right away, and not for other years. So that could trigger some timing issue or foreign tax credit issue, and could be a double taxation issue.
Cooper, one of my favorite expressions is there's a lot alike between Canada and the U.S. There's a lot of similarities, but when it comes to tax issues, it's the differences that count. And Canada, for example, doesn't tax lottery winnings, but the U.S. does. Canada doesn't tax the sale of a principal residence, but the U.S. does. Now, there's some limitations there. And there's lots of examples of things where Canada and U.S. tax transactions differently, and that can cause confusion.
That's right. There's a long list we can go over, for a whole day. So we'll save that for the future. So now when we go through these, you figured out your income, then you get some deduction. Like Canada, we get some personal, exempted income every year. In the US, it's similar. There's options. You get either itemized deduction, like mortgage, property tax, charitable deduction, and so on. Or you can just claim for standard deduction. It's like lump sum deduction you can get. Nowadays, it's like $13,000. So if you itemize the deduction is less than that amount, you can just say, I claim this higher standard deduction. However, if you have lots of things to claim the deduction, which would be more beneficial for you, you would rather to claim itemized deduction instead. So after these deductions, you will get on tax-free income. Then you apply for the tax rates, progressive rates as well. The top rate in the US federally is 37% now. So for people living in Canada, because usually you don't need to pay US state tax because you don't live in any specified states, So you just pay the federal level. However, if you have any real property income, in California, in that you have to report that state sourced income as well, in addition to your federal income. So these just two rates here. Usually, if you just live in Canada, most of your income is sourced in Canada. Usually, you don't need to pay any tax to the US after the foreign tax credit regime, because you see in BC and Alberta, the overall tax rate is higher than the US federal rate. So that's just basic about the US tax filings for the US citizens living in Canada. Warren, you want to take on the next slides talk about the filing status?
Sure, thanks, Cooper. So filing status, as Cooper already indicated, we don't really think about that because in Canada, we file tax returns as individuals. It doesn't mean you don't identify yourself as being married or not married or those sort of things. But in the US, there's fundamental differences here. And these aren't as obvious as you might like to think they would be. But the first thing I want to point out is that the best tax rates are the married filing joint tax rates. Now, when I say that, you hit the top marginal rate of 37% federally in the US at about $650,000 US dollars of taxable income. Now, if you compare that to Canada, you hit the top marginal tax rates in Canada in some provinces just over $200,000 Canadian. So even where the rates might converge, the rate structure is hugely different. Someone making $1 million and living in California would pay a tax rate of about 50% at that income level, and they'd be paying 48% in Alberta. But their tax at $1 million would still be less than Alberta, even though the Alberta rate's lower because you only hit that top rate of 50% at $1 million US of income. So the tax rate structure is huge here too. So the married filing joint rates are the best set of rates. The married filing separate tax rates are the worst set of rates. Instead of hitting that top marginal rate at $650,000 of income, it's exactly half. You'll hit the top rate of 37% at $325,000 of income. So there's very significant difference. Now, most people automatically sort themselves in a category saying I'm married or I'm not married. That's not as easy a question as you might think it is, because it's not US law that determines your status. It ends up being local law. So the fact that you might not be married under a US state law doesn't mean you're not married under a Canadian provincial law. And that includes common law marriages, includes same-sex marriages. that means you're married for U.S. tax purposes. Now, I will say there's some uncertainty about some of that subject, not so much on the same-sex marriage side, but on the common law marriage side, and you have to look more closely at that. Very few states have common law statutes, so it's a little bit of an unusual question in a U.S. context. Of course, a lot of our listeners here are married, and so they automatically select themselves into married filing jointly or married filing separately. And typically, if you're both U.S. citizens or both residents, or one's a U.S. resident, one's a U.S. citizen, you're going to want to use the married filing jointly rates. There's very few tax reasons to file married filing separately. I won't say they're non-existent, but they're really quite unusual. We see that very little in our practice to do that. But under the married filing jointly, U.S. citizens and U.S. residents can do that automatically. It's also true if you're a U.S. citizen or a U.S. resident and you're married with a non-resident alien spouse, you can also elect to file a joint. Now, a lot of people express horror at this option, like, why would I ever want to file a joint tax return and drag my Canadian spouse into the U.S. tax network? So there are some bad things that happen. But there's also some good things. We'll talk about the bad news first. The bad news is that Canadian spouse will now be subject to U.S. tax on their worldwide income. They'll also be treated as a U.S. person for U.S. tax purposes. And that may require them, and we'll talk a little more about this later, but if they own a Canadian corporation, they have to report that for U.S. tax purposes. If they're beneficiary of a trust in Canada, they may have to report that. All those same rules that apply to a U.S. citizen or a U.S. resident would also apply to that non-resident alien spouse, and they'd be taxed on their worldwide income. So there's some bad news there. Also, if you make this election and you revoke it, you cannot elect it again unless both spouses became either U.S. citizens or U.S. residents. So once you make it, you can carry on doing it each year, but once you revoke it, it will stop you from making that election again. So why would people choose to file jointly? Well, there are some good reasons about filing jointly. One of them is can maximize the foreign tax credits. In other words, by filing jointly, it may reduce your U.S. tax liability. And you say, well, I paid very little U.S. tax. But remember what happens is you've got a lot of tax you've paid in Canada. It's going to, by using the married filing joint status, it's going to reduce your level of U.S. tax, and it increases the foreign tax credits that are available to you. Now, I have a saying that goes like this: foreign tax credits are like cash. You just have to find a place to spend it. And I'm talking like a tax guy here, so you'll have to forgive me for that. But what you want to try and do is when you maximize your foreign tax credits, it allows you to offset some future event where, let's say, something's taxable in the U.S., but has maybe a lower level of tax in Canada, or is taxed at a different time in Canada. And there are a few things that fit in that category. So foreign tax credits can be very valuable to people. And by filing jointly, you get to do that. And that may be a valuable thing for you. So if you're married, think about that. Should I be married filing jointly or married filing separate? What are the benefits of that scenario? The one that is kind of news to most people, it has an interesting twist to it, is a head of household. And to qualify for that status, you have to be a U.S. person with a qualifying dependent. And a qualifying dependent usually means that you're providing more than 50% of their support. The U.S. person also can't be married. Now, this is where it gets really interesting, because the Internal Revenue Code, which is what U.S. tax law is based on, says that you're considered to not be married if your spouse is a non-resident alien. So potentially, if you're a U.S. citizen living in Canada with a non-resident alien spouse, you could qualify for head of household if you have a qualifying dependent. And the head of household rates are better than the married filing separately rates. They're not quite as good as married filing jointly rates, but there may be a tax advantage for you there too. The last one is qualifying widow or widower with a dependent child. These individuals can qualify for up to 2 years to use the married filing jointly tax rates. So there's an advantage there. And so that's the 5 different U.S. tax filing status. And a lot of people can actually fit in many of these categories potentially, depending on what their exact facts are. So, Cooper, I'm going to pass it over to you to talk about foreign earned income exclusion. Wow, that's a big name.
Yeah, people love this, exclusion, credit. That's the money you just talked about. It's cash. You have to use this. Okay, so yeah, for people living in Canada, your home is here, your job is here, so this is the way, the 2 main regime you can claim to exempt your income or get credit offset U.S. tax. So first of all, the foreign earned income exclusion, this is for earned income, you see, it's not about the passive earnings. Earned income is for your salary, self-employment income, business income. So for these, if you have benefit home in Canada, or you just new to Canada, however you have something, you spend 330 days in the consecutive 12 months, you're qualified for this exclusion amount. So each spouse will get nearly 110 grand US dollars. If you file jointly, if you file just married separately, you just claim your own portion for this. The form is 2555. You will see the details on that. There might be some pro rata-based calculation. There's also be some additional benefits to claim the housing costs. So the more detail you can take a look at that. Will not go through too much there. But often we often claim is on the foreign tax credit because
so
of the foreign tax
credit. Why would the U.S. government is giving you $108,700? Why would you not choose to take that?
Oh, that's something very good question. I cannot say because if you cannot use it, usually cannot carry over. It's different to foreign tax credit here. Foreign tax credit, if you don't use it up, you have a balance, you can carry over for future years, just in case your incomes vary the different years. And that's only for earned income. So basically, foreign tax credit, it's a little bit more beneficial, more flexibility there.
That kind of goes back to the comment I made earlier, saying that foreign tax credits are could be really valuable to people. Yeah. And maybe not in the current year, but in a future year. And so, yeah.
That's right. I mean, for tax credit, there's more complexity here. You will see I put more notes here. There's lots of limitation nowadays. Last year, the IRS has just updated the final regulation on the FTC for tax credit. So now there are 7 categories of high income or basket income you have to follow. You cannot, let's say, you pay tax in Canada on dividend income, then it's passive income credit. You want to use it to offset some other categories of income, like salary income. So in the different basket, you cannot cross to claim. So there is some limitation there. But for most ordinary people, often we cross the passive income and the general limitation. These are 2 main baskets for the foreign tax credit claim. when you pay the tax, sometimes you already paid the tax by installments or by withholding tax through your employer. However, sometimes you have not paid that yet by the tax filing, a tax return you're preparing. You're going to pay later or with the tax return submission. So there's a paid basis or an accrued basis for foreign tax credit or claim. You have to keep consistent every year. You can change, but you would have to, to do some calculation to match that up. And also for the timing for foreign tax credit, sometimes, like I mentioned before, the income recognition could be different in both countries. Let's say installment sales, or some stock option income recognitions. Those type of things happen. So in one country, you recognize income, but not for another country. So for the tax credit here, this regime allows you to, kind of accumulate your credit in one basket that if you don't use it for now, you can use it for future. So that's a very beneficial. Then sometimes you have to keep in mind, you pay some tax, but that tax could be changed. Let's say in Canada, you pay tax to CRA. However, for some reason, you amend the return, maybe for loss carryover or for some other reasons, or you get some refund from CRA. So in our tax language, we call the tax credit or redetermination. In that regard, by U.S. tax law, you have to amend your U.S. tax return as well to, they don't want you to overclaim the credit. It's just, you have just to claim whatever you paid, actually paid. So within 2 years window, if anything happens, you would have to notify the IRS for the change. Then the form is 1116. It's a long form, very complicated. If you want to do that by yourself, good luck. Otherwise, seek help from the professional advisors.
Excellent. So we've talked a bunch here about foreign tax credits. And one of the things that you should know is that for U.S. tax purposes, foreign tax credits can be carried back a year or forward for up to 10 years. So there's a long lifespan associated with foreign tax credits. And they can be very valuable to you. They're not so valuable if you live in Canada as much as if you move outside of Canada, but they can still be valuable for Canadian purposes because, as I indicated before, while U.S. and Canadian tax are similar, it's the differences that count. And so foreign tax credits can be a means of minimizing those differences. Now, one of the questions that happens for foreign tax credit purposes, who gets to tax the income first? Generally, for U.S. citizens resident in Canada, they will pay the higher of the two taxes. So Canada is typically that country. But the question is, who gets which share of income? And the governments want to get their tax first. And the country that taxes second has to give up a foreign tax credit to reduce its tax for the tax already paid in the other country. So the important issue becomes the sourcing rules. And these are far more detailed than we're going to get into here, but at least I want to give you some information that surprises many people. The source of your employment income is not based on the currency you're paid in, and it's not based on who or where your employer is. There's some limited exceptions there, but it's based on where you actually provide your services. So if you're employed by a Canadian corporation, get paid in Canadian dollars, but do all your work in the U.S., it's actually U.S. source income, and the U.S. may have taxing rights first. We're actually going to be talking about this subject more in a future webinar. So employment income is sourced to where the services are provided. Dividends are sourced to where the payer of the dividends is. That seems fairly obvious. Interest is sourced the same way to where the payer is, except when something unusual happens there, is that the interest is exempt from tax under the treaty. And just so happens that most forms of interest income are exempt from, received by Canadians, are exempt from US tax when paid by a US payer. There's some limited examples where they're not, but most cases are from banks and bonds and things like that. That interest is free of US tax and received by residents of Canada. The last category is gains. And again, this surprises people. If you own shares of General Motors and you sell them at a gain, or you sell them on the New York Stock Exchange, the income is not sourced based on where that entity is located or in the stock exchange it's located. It's actually sourced to where you reside. If you're a resident of Canada, that gain is Canadian source and Canada gets a tax at first. There's some limited exceptions there. You know, if you sell U.S. real estate, it's always sourced to the country where the real estate was located. Certain business assets have a similar sort of rule there too. So, that's fairly straightforward. Now, there's some unusual things that happen here because those of us that do international tax say, U.S. tax treaties are not very useful to U.S. citizens because in most cases, U.S. tax law prevents U.S. citizens from getting much benefit from treaties. So, for example, the withholding rate under the treaty for dividends is 15%. But the U.S. says if you're a U.S. citizen, they're fully taxable in the U.S. But Canada says, why are we giving a special rule to U.S. citizens? No, you're going to be taxed the same as Canadians. Canada is only going to give a U.S. citizen resident in Canada a 15% foreign tax credit because that's what the treaty says. Well, that creates a problem because now a U.S. citizen resident in Canada is going to be fully taxable in both countries, but only get a 15% foreign tax credit in Canada, even though they paid a 20% rate or potentially a 25% rate on that income in the U.S. The treaty credit mechanism is an unusual rule that sits in the treaty that solves that problem. Now, what it does is for that dividend from General Motors, a U.S. corporation, for U.S. tax purposes, it ends up at the end of the day treating it as though the General Motor dividend came not from the U.S., but came from Canada. And it's a way of getting around those rules so U.S. citizens are not subject to double taxation. Now, I made a comment about treaties here, so I'll expand a little bit. Treaties are about preventing double taxation. They are not perfect vehicles. And so you always have to be careful if there's a situation where you could fall into double taxation. Usually it doesn't happen with mainstream items of income like employment income, dividends, interest, and gains, but it can happen in unusual certain cases. Now, we said we'd make some comments about Canadian foreign taxes or foreign tax credits here, and there's some limits. Canada, like the U.S., has baskets, but unlike the U.S., it actually limits the foreign tax credit based on country-by-country basis. So if you have income that's subject to Peruvian tax because it was earned in Peru, you can only use those foreign tax credits to offset income from Peru. The U.S., on the other hand, says all foreign tax credits can be applied regardless if the income was earned, the tax was paid in Peru, and the income was earned in Australia. Now, as Cooper mentioned, there's some limits by the baskets that limit that, but the U.S. rules on foreign tax credits are much broader than the Canadian rules, and that can limit their value at a Canadian tax level, but the U.S. ones can be very valuable. So I'm going to pass it off to Cooper to talk about U.S. net investment income tax.
Thanks, Warren. This is just follow-up to that foreign tax credit issue because this is a tax levied in the U.S. It's called net investment income tax. It's kind of new, not that new. It was enacted when Obama, was in the U.S. administration. So to fund the Obama, the whole society's medical system deficit, these kind of a tax, we call it rich tax or Obamacare tax, was introduced to tax rich people who earn passive income. So this is only for passive income. However, when you determine the filing threshold, your general income, that counts. So it's the tax rate 3.8% here. It's like adds on to the 37% of the top federal rate we mentioned before. It's more on, like I said, on investment income, dividends, interest, capital gain, royalties income, rental income. So that's the regime. And however, the more important thing here is usually the Canada, or when you live in Canada, you want to claim your tax to the U.S. on your U.S. tax return. For this additional tax cannot be observed by that foreign tax credit offered by Canadian tax. Why? On the tax code, I don't want to get this too complicated, but this is like a new tax they put under the different chapter of the tax code. So if you follow the foreign tax credit, it goes nowhere. Cannot fit in the foreign tax credit categories. And also, this is a very controversy. People say, hey, I pay lots of tax in Canada, even more than US. Why you charge us additional, Or they can say, hey, I live in Canada. I'm paying all of my Social Security taxes in Canada. Why I still have to pay the US tax on this additional part? It is extra burden. There's no good way to offset that by the Canadian tax. I mean, in practice, the IRS has not provided more clarification on this regard. So, however, in practice, like I said, arguably it's kind of the Social Security tax. So Canada and the U.S. also has totalization agreement on Social Security tax, not in addition to the traditional income tax treaty. So that's something people are trying to play, trying to say, can we claim a position here to exempt this tax under the Canada-U.S. totalization agreement? It's a gray area, to be honest. It's risky. Like I said, IRS has not provided any guidance on this. Gordon, do you have any comments on this?
Yeah, well, net investment income tax is a tough deal because of that limit on foreign tax credits, that you can't use Canadian tax to offset the net investment income tax. Now, as you kind of intimated, Cooper, if all your investment income was U.S. source, there is an argument saying that the Obamacare tax, the net investment income tax, can be claimed as a foreign tax credit in Canada. And, that people have been successful in making that claim. That's not as problematic. But it bumps up the U.S. tax rate. We say the top U.S. federal tax rate is 37%. That's the regular income tax rates. When you throw in the 3.8%, suddenly it's almost 41%. And these taxes are real. And those of you who've said, hey, I don't pay any U.S. income tax, how come I'm paying U.S. income tax this year? I mean, this has gone in now. Correct me if I'm wrong, Cooper, but I think this goes back to 2012.
13. Yeah.
Yeah. So it's been there for a while. And it's usually the net investment income tax, if you have income over the thresholds noted there, you'll have that issue. This is another case where you may want to think about filing jointly with your non-resident alien spouse because you'll get a higher threshold there. And especially if your spouse doesn't have substantial income, that can be an attractive thing.
Absolutely. There is another layer of complexity here. If you cross a situation where you need to include some other type of income, let's say we often call the PFIC income, passive foreign investment income, company income, or like subpart F income, for the foreign or the non-US controlled foreign corporation income. Usually it's referred to passive income generated in your controlled corporation in Canada. In the US tax law, they don't want you to defer passive income in the foreign country without paying the US tax right away. So there is a punitive tax regime to play here to force you include those incomes, because those income are typically passive income. So when you determine whether you need to include those special passive income into this regular passive income subject to net investment income tax, that could be very challenging. There's a bunch of tax regulations there we can go through. Basically, it says that there is some timing difference because you have not received those income from your, let's say, from your controlled foreign corporations or passive investment income company. So they don't want to tax you right away. However, you have options to include those right away. So it depends on your own particular situation. There are some options or elections there you can choose. So I don't want to get too much detail, but that's just something I would say net investment income. It's very complicated. And even though it's just like a one line on the tax return, but when we go into the details, lots of things to talk.
Who said taxes weren't fun? Like, this is great stuff, right? So we'll chuck the next category here, and we're getting a little close on time, so we'll pick things up a little bit here. I want to talk briefly about trust. We have one slide for this. We could talk for a day in this subject. But one of the things I want to focus on when I say non-U.S. trust, and we're really kind of focusing on trusts in Canada, is the issue is not whether it's a trust under Canadian law, it's whether it's a trust under U.S. law. And there's some important things to know in this subject. This is a subject confusion. We have several questions on the subject too. For example, tax-free savings account. If you look at the materials you use to sign up with your bank or your investment advisor, it says it's a trust. But the real question, is it a trust for U.S. tax purposes? And, the conclusion has been with things like a tax-free savings account is they're not a trust for U.S. tax purposes. The IRS has not formally made a statement. They've made informal statements about tax-free savings accounts. But they did make a ruling on a Mexican trust, which has a lot of similarities with the tax-free savings account, and it concluded it was not a trust for U.S. tax purposes. And because of that, you didn't have to file IRS Form 3520 or 3520A, which we'll talk about briefly shortly. And what are the differences for income tax and estate tax purposes? So one of the things to think about here when you're planning with a cross-border tax advisor is, what happens to that trust? And what's called an intentionally defective grant or trust means the income is taxed to the owner, but for estate tax purposes, it's actually taxed to the beneficiary. In other words, it's not taxed in the grantor's estate. So there's a lot of things in the trust area. We've done a webinar on this before. You can look it up on YouTube. We've done a bunch of these, and there's a lot to talk about in this subject. Again, I'll talk briefly about two fundamental differences in trusts. grantors versus non-grantor trust. A grantor trust, and I'm going to use very simple terms here, is where the grantor controls the trust. And that control can be direct and it can be indirect. And what happens for U.S. tax purposes, the income is all taxed back to the grantor, not to the beneficiary. In a non-grantor trust, the grantor makes a grant to the trust, but doesn't control it. The income in that non-grantor trust is taxed to the beneficiary. And there's some extraordinary complex rules about the subject in the non-grantor trust area specifically that can be very adverse to U.S. taxpayers unless they get the attention they deserve. And these are the rules that prevent or discourage U.S. persons from putting money in a trust in Bermuda and letting it perk away and not be subject to U.S. tax, because when it's distributed to the U.S. beneficiary, the U.S. has what are called throwback rules that are designed to tax it as if the beneficiary had actually received the income when it was earned. So this is a complex subject. I think, Cooper, we'd probably both agree that most family trusts formed in Canada are grantor trusts. Simply, that's designed. If you're going to form a trust, make sure you have a cross-border tax person involved in its formation, because you could end up with the income being taxed to the beneficiary in Canada, but to the grantor in the U.S., and the result being is you have double taxation. And so that's a common issue for Canadian trusts. Cooper, I'll pass it off to you to talk about IRS and U.S. tax international information.
Let's go back to the trust slides. I have 2 comments here, if you don't mind.
Sure.
Yeah, I think you mentioned very interestingly for the, beneficiary receive the distribution, get taxed in Canada, but for the U.S. tax could be all of the trust income attributed back to the grantor who happened to be a U.S. citizen, then the income would have to include in his income. Then for foreign tax credit, you cannot claim because the taxpayer identity mismatch, right? That's why you cannot claim the foreign tax credit because it paid by Canadian tax was paid by beneficiary. But when you're trying to claim the credit, it's the grantors, the different people, So that's good part. Just to clarify that. And also one important thing we often got neglected in Canadian tax world is under the U.S. tax law, if you have something transferred by a U.S. person to a foreign trust, that is a deemed disposition for the U.S. tax purpose. So there will be a capital gain income to be recognized right away upon the transfer. That's something to keep in mind as well.
So if I put my shares of Apple into a Canadian trust, I might not have a Canadian tax liability, but bang, I'm going to have a U.S. tax liability.
Yeah, under the general U.S. tax rule, that is, it's deemed as a sale for the U.S. tax purpose. And also, the trust for the U.S. tax purpose sometimes it's different to Canadian, like you mentioned. Sometimes we cross some different countries. They call in the name, they call it trust. But when you look closely under the U.S. tax law, it could be a corporation that provide limited liability protection in that. The same thing in Canada, some trust or mutual fund trust in the name of the trust. But for U.S. tax reporting, it could be treated as a company. Then all of your income will be subject to the company or dividends, that type of income reporting. So like you said, it's a whole set of topics here. Just briefly touch on the common issues here. Then we go to the next slide, you will see so many firms, it's not just the 1040 or for the U.S. resident living in Canada. All of these sometimes we call it international information return or disclosure requirement by different tax laws. So the first one we often call the FBAR, foreign bank accounts report. Just to clarify, it's not just limited to bank accounts, could include lots of financial accounts. So that's
investment accounts and RSPs and TFSAs, they're all require FBARs.
Yeah, because financial interest you are in any accounts then is subject to this reporting. The filing threshold is pretty low. It's just $10,000 US dollar aggregate maximum income balances in the total accounts. So nearly everyone needs to report this form. We'll talk about the penalty stuff later, but just now briefly explain the filing requirement. So for the trust, the gifts, we talked about that briefly. So you might be subject to 3520 and 3520 Cap A, these two forms reporting. Then we talk about the Subpart F income controlled non-US corporations earlier. So if you are in that situation, you would have to file 5471. In practice, I often see some confusion. People say, hey, I only have like a 20% shares in the corporation, why I need to file these? Unfortunately, there are some attribution rules, constructive ownership rules. Let's say if your families or your relatives or by indirect holding through some business entities, then you are deemed to own more than 50%. So these forms would be required for you to file. It's different to the Subpart F income inclusion, but just for the form itself, for the disclosure purposes, the requirement will be, the loser. So you have to file that sometimes, even though you just own a small fraction of interest. Then people often talk about PFIC. So here's a passive foreign investment income company. PFIC usually is about, passive income in the foreign company. If you don't receive that for now, you accumulate that for many years, then there is some, they call it throwback tax regime to deem you have earned those income in previous years, then they're going to charge the penalty or the tax and the interest income on that, assuming you have earned that spread in different years. Then if you own some disregarded entity, the branch business or a partnership income, or you're a partner in the foreign partnership, then these two firms, 8858, 8865, are required to be filed, respective. Then last of 8938 here is kind of similar to the FBAR, but it's one schedule to your tax return itself. You file at the same time. 99 or 95% of accounts will be identical. You still need to file these both forms, but there are some different exemptions and also overlaps. You would have to disclose on these four in addition to FBAR. Like I mentioned, the deadlines, some firms, they have their own filing deadlines and have their own extensions to file. If you fail to file those forms timely, correctly, the penalty could be assessed. Usually in the US side, the penalty is very significant.
So what's very significant, Cooper? That sounds vague. So what are we talking about in terms of dollars?
Generally, let's say it's $10,000 penalty per year per failure. To start, yeah. So
and
sometimes
some of these actually involve potential criminal penalties and imprisonment. So that's mostly the F bar.
Yeah, we don't want to go that crazy, but it could go to, let's say, 35% of the account value. Let's say, for the trust, you have $1 million there, or you have foreign corporations or some accounts did not close. Then if you got assessed, no matter it's 10%, or 25, or 35%, that's very significant amount.
That sounds significant to me. I'm sure it does to most of our
listeners. Don't be scared. Yeah, like I said, if you fail to file this, the IRS, sometimes they're good. They're a little generous here. They provide a different...
Just hang on a second, Cooper. You said the IRS was generous?
Well, they provide our relief programs, for us to voluntary disclosure. They provide relief on penalties. However, you need to follow the procedure correctly, So there are different types of procedure. We often talk about the streamline or OVDP, voluntary disclosure, or you submit a return with a reasonable cost. If you have a legitimate reason to show those are reasonable costs, the standards, the bar is very high, to be honest. Then if you have report all of the income from these, all of these entities or accounts, but just fail to file the forms, there is some international delinquent program for you to get in, to get compliant. So, this is lots of criteria for you to get in, to get qualified. Then once after submission, you still need to deal with a few rounds of communication with the IRS. So if you, like I mentioned, the penalty is here. If you don't file the form, the statute of limitation will not start to run. So the problem there will be carried over for many, many years until these forms are filed eventually. So be careful. Talk with your tax advisor. Get these compliant.
Excellent. And Canada doesn't have quite as long a list, but it does have some similar filing obligations as exist in the U.S. And these have been ramped up in a few years. I'd say particularly this CRA form T1134 is for foreign affiliates. That may include a corporation formed outside of Canada, a partnership outside of Canada, a limited liability company outside of Canada. And again, just like the U.S. equivalent, there's penalties associated with these. Most of our clients that have investments outside of Canada will be familiar with the form T1135. And that requires you to report investments outside of Canada. And, if, for example, you have a brokerage account in the U.S., you'd be required to make additional disclosures that wouldn't be required if you had the same shareholdings in a Canadian brokerage account. So, Canada has, again, I'm going to say similar rules. Contributions to foreign trusts, there's disclosure there. Distributions and debts of foreign trusts, disclosure required there. There's penalties associated with that. So, there's lots to be wary of here. There's lots of well-intentioned people that tax law, unfortunately, has gotten so complex in a globalized world that both the Canadian and U.S. government are very concerned what happens outside their borders. And consequently, there's a very high level of disclosure associated with investments. It's not that you can't make those investments. It's just that there's a disclosure requirement there. So that changes kind of the shape and complexity of your personal tax returns. Now, we're almost at 10 o'clock here, and we said we'd be an hour, but we're going to have some time for questions. But please do complete a survey for us. We've got some questions. I'm going to ask Kathy Lee, one of our team members, and Lena Samin. They've been looking through the questions that people submitted. And Kathy, do you have some questions for Cooper and I?
Hi, Warren. Yes, we do have a couple questions that we'd like to ask. The first question here is, if I was paid W-2 wages while physically in Canada, is that considered Canadian source income? And if so, how do I indicate that on my taxes? And I think Cooper covered this topic here.
Yes, generally, as to source the income, you need to look where you reside when you render the services. So even though you got W-2 wages, but all of your services are rendered in Canada, generally it's Canadian sourced income. I know practically speaking, sometimes you work for a US company remotely, especially nowadays. They just want to do their own stuff to withhold the tax, Then in Canada, they also argue that's a Canadian source income. So you need to kind of get these two parties and yourself to sort it out, to get a waiver in one country. Usually you get a waiver from the US tax authority. You just pay the withholding tax to CRA.
Yeah, just to add on that, I mean, W-2 income, if all the income was earned from service provided in Canada, I can't say always, but will almost always be fully taxable in Canada, and none of it's taxable in the US, except to the extent the recipient was a US citizen. Now, that means Canada gets taxed the income first and the US gets taxed a second. But there's also a bunch of underlying issues for the company that's the payer, because by having an employee based in Canada, they could actually end up with a corporate tax liability from that. That's usually a more solvable issue, but these withholding issues are important. And the importance is that the recipient shouldn't have paid US Social Security and Medicare tax. They wouldn't be subject to state income tax either. And they should have been paying Canada Pension Plan. So this has become a really common problem to our clients in the last year with the pandemic.
Great. Thank you, Cooper and Warren. And speaking of Social Security, we do have a question on that for you, Warren. If a Canadian wife receives spousal Social Security from her resident alien American husband, but she has given up her green card, does she have to file U.S. tax due to this Social Security?
Boy, there's a few twists in there. If the spouse receives Social Security income and she's a resident of Canada, she's not subject to U.S. tax. So she has no U.S. tax filing obligation associated with that. And if tax is withheld in the U.S. for some reason, she can file a tax return and claim a refund back. But you have to be careful in those situations. And this is why this is a rule under the Canada-U.S. tax treaty. The treaty rule was put in place because, there were people that were receiving relatively small amounts of U.S. Social Security income, having tax withheld on the amounts paid to them. It cost them more to actually file a tax return to get the money back. And so both Canada and the U.S. agreed if you're a recipient of U.S. Social Security and you're a resident of Canada, it's only taxable in Canada. Vice versa, if you're a resident of the U.S. and you receive monies from Canada Pension Plan, it's only taxable in the U.S.
Great. Thank you so much, Warren. The next question we have, I believe Cooper covered. Does the net investment income tax include gains realized by sale of assets, or are they only for things like dividends and distributions?
Well, generally, the capital gain is subject to to the net investment income. That's correct, unless there is some active business, the assets use it in the active business. So that's kind of exceptions. Generally, the dividends are net interest income, royalty, rental, those are passive income. I believe for dividends, if there's some flow through from some company you actually control, that business income is from active business, there's some exception there as well. So like I mentioned, there are lots of details there. You need to go through the regs. So we're now just cover the basic, like I mentioned, it's only for the passive income, net investment income tax.
Great. Thank you, Cooper. We have a question regarding 3520s and 3520As. So the question here is, I have heard the rules for RESP have changed now, and we don't have to file 3520 or 3528 anymore. Can you please clarify the forms we do need to fill out?
That's a good question. That's correct, is 3520 and 3528s are not required for registered educational savings plans, RESPs. That does not mean that the U.S. person involved doesn't have to file an FBAR or doesn't have to file Form 8938 that Cooper talked about briefly. So yeah, that obligation continues, or it's a different filing obligation. The 3520 and 3528 were fairly significant forms and have a relatively high level of complexity associated with them.
You mentioned good points for don't forget about those forms. Another thing I would like to add is if the owner of the RESP or the fund contributors is U.S. person, then generally you still need to include the income because you treat it as grant or trust for U.S. tax purposes. So that's a headache. In Canada, you want to accumulate some income for the education purposes. However, IRS does not provide relief in that regard, even though they have some 529 plans in the U.S. domestically to provide. It's very similar to RESP. For the domestic, it's tax default, but unfortunately in Canada, they don't have that relief. So you would still have to include RESP income on your tax return annually.
Yeah, that's a great example of the U.S. taxing the grantor in an RSP, but Canada's taxing the beneficiary. And we've got tax being paid in both countries, but we can't offset them because they're different taxpayers. Kathy, did you have one more question that was important for us to answer here?
Sure. This one's fairly straightforward, but I think it'll really clarify things for a lot of viewers here today. Is there a time limit on the tax credit carryovers?
Well, the foreign tax credit, it's 1 year carry back and 10 years carry forward. So yeah, there is a time limit on it. Yeah, I presume they're talking about foreign tax credits there.
Yes, that's right.
Okay, yeah. Excellent. Well, thank you so much, Cooper. Thanks for being with me on this session. And thank you to all our viewers here. Please do complete the survey. We're interested in your input. If you have ideas for future webinars, we'd be glad to hear them. We actually have a lineup that we've kind of put for the year here, but we're always looking for new ideas. And appreciate your attendance and look forward to speaking with you personally at some point in time. Thank you.
Thank you, everyone.